I've had a few people ask questions about 1031 tax-deferred exchanges and how that's relevant to building a self-storage business. I thought everyone really knew about 1031 exchanges, but I guess if you don't have a real estate background, how could you know about them? So let's talk about that today. Let's talk about 1031 tax-deferred exchanges and how that strategy might apply to you as you get in or grow your self-storage business. My name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage. And I'm also the creator of the Self-Storage Quick Start Academy. And what I do is I support the small investor who wants to get in the self-storage business or who wants to grow their self-storage business, do so strategically in a way that creates true wealth and a fulfilling career. Training at creatingwealththroughselfstorage.com and at thequickstartacademy.com. But one of the real benefits of self-storage is it's a real estate play. Yes, it's a business play, but it's also a real estate play. And nothing has the tax advantages that real estate offers investors. If you think about it, depreciation, appreciation, interest write-offs, operating expense write-offs, cost segregation reports. There are a ton of tax benefits that help people who invest and own real estate. Much more so than any other type of investment vehicles like stocks or bonds or mutual funds or even starting another type business. The tax advantages that real estate is afforded is amazing. And at the top of the list is the 1031 tax deferred exchange. And I use that in quotes because I've heard a lot of people call them tax-free exchanges, and they're not tax-free. Other than the person in the White House, when he created the opportunity zones, whereas if you hold a property for more than 10 years and it's in an opportunity zone and you do certain things, then there will be no capital gains. That is a tax-free situation. But other than that, I know of no tax-free situation in real estate. But what it does is it allows you to roll your tax basis from your existing property into your new property. So let's talk about 1031 tax deferred exchanges and how it might relate to your self-storage business. So first thing we're going to do is just look at the basic mechanics of a 1031 exchange. Section 1031 of the IRS tax code was not part of the original Revenue Act of 1918. It first became a section in 1921 and it has been modified a number of times. 1924, 1929, 1933, starker in the 70s. So this section of tax-deferred exchanging has evolved over the years and is one of the best benefits afforded a real estate investor. I'm not a tax expert, and I'm definitely not a 1031 expert. I've just been involved in a few of them myself, and especially over my years as a commercial broker. So I'm going to talk about some of the mechanics of a basic 1031 tax-deferred exchange. So if you want to sell a property, let's say that you own an investment house or a piece of land, a raw land for development, or you own an apartment building or a self-storage facility, any type of income producing commercial real estate, as long as it's not your primary residence, and you sell it, and you think you're going to buy another piece of real estate with the money, you should really consider a 1031 tax-deferred exchange, unless you just like giving money away. So that property that you sell And once you get it under contract, there'll be some certain language that an attorney needs to put in your contract referencing a 1031 tax deferred exchange. Ask your lawyer about that. But when that property closes, that is, quote, the first leg of the exchange. So let's say you've got it under contract. The day it closes, that first leg has occurred. Now, the good news is you can, rather than go out and buy another piece of real estate, you can, quote, exchange that for another piece of real estate and have the capital gains tax that you would normally pay, you wouldn't pay or pay all of it, because you would be rolling your basis from the first leg of the exchange into the second leg of the exchange. And the good news is you can only exchange for, quote, like-kind property. Any type of commercial real estate, as long as it's not your primary residence, is like-kind property. You can trade a rental house for raw land. You can trade raw land for an apartment building. You can exchange an apartment building for a storage facility. It just has to be not a primary residence and designed to be a real estate investment that will someday or immediately generate income for you. That's pretty much the definition of a like kind. Now, once you close on the first leg of the exchange, you've got to find, quote, replacement property. Now, there are some rules around replacement property. Now, I'm not going to get too much into the weeds. I'm just going to touch on them, and you can do your own research. But the first rule is what we call the 45-day rule. Now, you don't have to wait till you close to start looking for replacement properties. But from the day that the first leg closes, you have 45 days to identify, which is basically writing it down and giving it to your accommodator, which we'll talk about in a minute, your replacement property. The next rule I want to talk about is the 3 property rule. You can list up to 3 replacement properties of any value. So if you're not sure if you can buy the center or the storage facility you're interested in, you can put 3 properties on there of any value. And if any one of those becomes your replacement property, then your exchange is a good exchange. The next rule I'm going to talk about is the 200% rule. In the 200% rule, you can have any number of properties identified as replacement properties, but the combined market value of all of those replacement properties cannot exceed 200% of the value of your first leg. And I'm just going to touch on probably the most confusing rule of all, which is the value of the debt replacement. Most people think that if you sold a property for $1 million and you had $500,000 in debt, you've got to buy a property or replacement property at least worth $1 million and have at least $500,000 debt on it. Well, that would work, but you can replace the value of the debt with cash, seller financing. It doesn't have to be bank financing, but you have to be very specific on how the debt value, however much debt was in leg number 1, is, quote, replaced. Otherwise, the difference in that could be subject to a capital gains tax. Now, when you close the first leg of your exchange, you cannot receive the money. That's called constructive receipt. If you get the money from the sale of the first leg, then your exchange is voided. What has to happen is it has to go to what's called a qualified intermediary. And there are some companies out there and attorneys that we've used that have acted as qualified intermediaries. You want to have a company that has a good track record of success with exchanges. This isn't the first time they've done it, because they're going to take your money and hold it till you close on the second leg of your property. You can Google and look up qualified intermediaries, and you'll see a whole lot of good companies out there. In essence, what happens is, rather than you getting a check for your money goes in an escrow account and sits there till you close on the next leg of the exchange. So, once you close on leg number one, and once you've identified the replacement properties, you have 180 days from the closing of leg number one to close on the replacement property. You do that, what happens is you don't pay a capital gains tax on the sale of the leg one property. Your tax basis is rolled into the next property, and you're able to use 100%, if you want, of your equity in the purchase of the replacement property. Any cash that you do take out of that is called boot, and that boot is subject to a capital gains tax. If you had $1 million in exchange, you could take $200,000 out and pay bills with it and have the rest of it remain as part of a 1031 tax deferred exchange, but you will pay capital gains tax on whatever amount of boot that you take out of the exchange. So there are a lot of experts out there to support you. So I've just barely touched on exchanges. There are all kinds of nuances and literally different types of exchanges. You can do a reverse exchange. There's starker exchanges. There's a whole world out there of 1031 exchanges, and I don't want to get into it right now, but I've got into the basic elements of what probably 95% of all exchanges look like. So now let's talk about 1031 tax deferred exchanges as part of a strategy for building and growing your self-storage company. Now, I'll be the first to tell you that I have not taken advantage of the 1031 over my career like I could have, or like I wish I had, simply because I've been involved in a lot of partnerships, and it's a little more complicated in partnerships. It's not impossible to do, but it's more complicated. But let's think about a strategy. Let's say early in your career, or when you first get going, let's say you bought a $500,000, let's just say storage facility, a small storage facility with $300,000 worth of debt. You did a value add play, and 5 years later, that $500,000 property is worth $1 million, and let's say you owe $200,000 worth of debt on it. Rather than just sell it, you can sell it and have that $800,000 equity now go into a qualified intermediary, and you buy a $1.2 million property, but at least $200,000 worth of debt on it, and then 5 years later, that's now worth $3 million. Rather than just sell it, you exchange it, and let's theoretically, over the course of 20, 30 years, you could end up from that initial $500,000 purchase owning $40, $50 million worth of real estate, and you haven't paid any capital gains tax. That's how you use the 1031 tax deferred exchange to help you maximize the amount of wealth that you can create for yourself and your family, because you're able to roll up to 100% of the equity created into the next project and not have to pull out any of that equity for the capital gains. Now, I know what you're thinking. At some point, you've got to pay that capital gains, and it's going to be a doozy. Well, yes, it will be a doozy. 30 years later, $40 million worth of real estate, that'll be with a zero tax basis in it. That's going to be a heck of a capital gains when it comes time to go out of real estate. But there's one way to kind of beat it. Now, it's not an exciting strategy, but there is a way not to have to pay the capital gains on that zero tax base. What you have to do is die. So when a person dies, the tax base for the estate of whatever real estate they're holding, commercial real estate, investment real estate, gets stepped up to the then market value, so that your estate would not be paying the capital gains tax on the zero tax base property if they disposed of it. Now, I'm not advocating that strategy. I just wanted you to kind of know about it. But a 1031 tax deferred exchange should be part of every real estate and storage investor's overall strategy, and should be another tool in their briefcase as they go out and create wealth using self-storage. So I've just touched on it. There are a lot of exchange groups across the country. Those exchange groups have been invaluable to me. I've done many transactions by being involved in the real estate exchange group in our local area. I would look and see if you can find one in your local area. In fact, if you remember in the book, Creating Wealth Through Self-Storage, on the case study I had at the back of the book, I had a storage facility under contract. My investors I identified walked. I had about a week left on the due diligence. What I did was I went to that exchange meeting, the exchange marketing session, and I found my partner by a property being offered for exchange. And I was able to close on that project and get back into business. When I was early in my career, my very first mentor told me, he said, you need to go to this exchange group and keep going till you understand what they do and what they're talking about. That was 30 years ago. I'm still a member. So perhaps now you have a better understanding of how 1031 tax deferred exchanges can support you as you grow your self-storage business. Thank you very much. My name is Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. That's the financial analysis tool we use to analyze the self-storage deals that we're going to exchange into that might be the replacement properties on the first leg of the exchange once we have that under contract. I look forward to being with you again soon, and I'll see you then.